there are a few additional things that I think support investing in more companies. So the first is the median venture capital firm or fund dramatically underperforms the mean one. And the reason for that is that there's this power law where it's basically the top 10% of funds produce almost all the returns, and everyone else is pretty lackluster. And so a lot of these firms are trying to invest in 10, 20, maybe 30 companies, and a lot of them don't get lucky and don't get a winner. They don't get one of those companies that's driving all the returns of the industry. And by making more investments, you get closer to the mean returns of venture capital, which are quite good. The mean returns of the industry are high teens, maybe even 20%, depending on the vintage.
Hey, everyone. Welcome back to the Ignite podcast. Today, we're delighted to have Peter Livingston. He's the founder and general partner of Unpopular Ventures. With over 12 years of angel investing experience focused on identifying startups off the beaten path, Peter and his team have backed over 450 companies, wow, including unicorns like GP, Yassir, Zepto. His approach of finding non-consensus and right opportunities has positioned Unpopular as a powerhouse in early stage tech investing. We're thrilled to have him on the program. Thanks for coming on, Peter.
Ryan, it's great to see you. Thank you so much for having me.
Yeah, thanks for coming on. So what inspired you to transition from founding the companies back in the day into venture investing?
Yeah. So to give you a quick rundown of my background, kind of been in startups more or less my whole career. Went through a couple as an operator at the beginning of my career. I got lucky with one of them. The other one was a complete disaster, but I learned a ton from that one. The one I got lucky with is a company called iRhythm. It's a medical device company. We develop devices for diagnosing heart problems. I was not a founder. I was the first employee and first engineer they hired. And just everything went right. We developed a product, launched it, raised a lot of money, grew really fast. And they're now a public company worth about $3.5 billion.
Oh, wow. Still around, still alive and kicking.
Still public, yeah.
Do you still have all your shares, or did you kind of trim off some of those?
Okay. No, I sold them. A frustration for me even to today is that coming right out of college, I did not get a lot. And I thought I deserved more. And I kept asking for more as I kind of showed my worth. They were never really willing to give me a lot of shares. So I actually didn't make that much money from that one.
Kind of the curse of being young, right?
It is.
You don't know what you're worth and you don't know how to negotiate and ask for it. I think like if you're 40 years old in that situation, you're like, no. Like I want this percent, you know?
Absolutely. And the reality was I was lucky to be there. I was lucky today. Like I was literally right out of college. I was probably more a liability than anything. They took me in, got a lot of responsibility very quickly. And because of the success there, it really teed up a lot of other career opportunities and it made a really good business school essay. I think I'm not sure if I would have gotten into a good business school without the success there. So
interesting. So you parlayed that into GSB when you applied. You're like, hey, look at this experience. And what made you go get an MBA? Like when I got my MBA, I always thought I'd like climb the ranks of product. So that's kind of where I was in my headspace. Notice all the product execs that I admired had MBAs. So that was like 1 and 1 equals 2 here. I'm just going to go get an MBA. But like you were like a post-exit exec, more or less.
Well, not really. I mean, I had been at iRhythm for 3 years. I kind of got all this responsibility. I played this role of I was effectively the leader of developing their main product with a big team. And it's funny. So I'd always thought I would do grad school of one kind or another. Both of my parents are MBAs.
We're both MBAs as well, my wife and I. So I was like, oh man, I'm sure there's going to be pressure for one of them.
Yeah. I mean, one of my first, so it's like, I thought I'd do it eventually. People said, oh, wait 4 or 5 years. But I was actually getting very frustrated at iRhythm that I was doing a lot of work, creating a lot of the value. I went to them multiple times and said, hey, I'd appreciate more stock than I have. They're like, oh, but you don't have much experience. Like, look at your boss. He has an MBA and a PhD. And look at this person. Their advanced degree. And well, it's like if you for you to get.
And what was your role there at that time?
I was the responsible for all of mechanical engineering and material science for all the products. And I was effectively the product leader on this Zeo patch, they're kind of their best selling product.
Okay, interesting. Yeah.
It's evolved a lot since then, but
right.
I led the team that developed the first generation.
Wow. So kind of like a head of product kind of role, or kind of like a quasi CTO because there's a medical device component here.
Yeah, it was not CTO. I mean, there's a lot to it. There's a whole software component and machine learning algorithms. So, there was a lot to it, and there were a lot of very smart people that contributed to it. But I was there. It was a small team in engineering, and I did it. And anyway, it just every time I kind of asked for any sort of promotion or more shares or anything, they were like, oh, well, if only you had more experience or if only you had an advanced degree. And it's like, well, okay, like, why would I stay here?
This sounds exactly like the conversation I have with my young engineering friends and, in their 20s. It's exactly the same kind of conversation. I'm having huge impact. Why am I compensated? Like I have a friend of mine that's at Amazon and he's just kind of stuck at like level 5, which is like a pretty low level. and he can't get to L6, and he's just kind of sitting there, just kind of spinning his tires.
It's actually very on topic too. I tweeted a little bit about this. You might remember a couple weeks or maybe a month ago, Vivek Ramaswamy kind of tweeted about Americans working hard or not, and maybe these H-1B workers work hard or whatever. And one of the big things was about how in the US, all the really talented technical people move over to finance and hedge funds and stuff, or software engineering, because that's where they can make a lot of money. And most STEM degrees pay shit, like really. And I don't know if it's just a supply and demand thing. Maybe there is a lot of supply in terms of these H-1B visas, or maybe we're churning out lots of STEM grads. There's this weird disconnect where everyone's like, oh, we need more STEM majors. We need more engineers of all kinds. And we don't, like Elon's saying, we can't find enough at Tesla. And it's like, well, wait a second. Like, I was what I thought was a pretty good mechanical engineer with a lot of experience. And like, I had to fight to get a raise from like 60K a year to 70K a year. And I would hear about people that did software engineering starting at 200K, or hedge fund people making 200 or 300 within a few years. I'm like, why are you, like, you're saying you need people like me, but why are you not willing to pay
You won't compensate us
people to develop products?
I remember maybe you had this experience at GSB, but at Berkeley, I mean, virtually the whole class was, not the whole class, but maybe two-thirds of the class was a foreign-born engineer looking to move over to a bit more business role, like a product role or.
Yeah, every now and then I connect with my mechanical engineering classmates from Stanford, which I would think is one of the top engineering programs, similar to Cal. And almost all of them have left mechanical engineering. They've all switched over to finance or hedge funds or software engineering. It's just, you can't make money as most types of engineering.
Yeah, is it because hardware maybe is just not infinitely scalable like software? So inherently you have more failure, like lower, more precision is needed, lower margins, less scalability, and then therefore there's just less money to go around?
It's a very good question. Yeah, maybe part of it is that you cannot go and found a hardware company by yourself very easily. It takes quite a bit of money. You have to have multiple team members, someone doing electrical, someone doing firmware, someone doing mechanic. So whereas software engineering, you could kind of jump out and start your own company.
A solo unicorn
join
founder.
YC with 2 people. Yeah. So maybe that's part of it. I think there's just another component. This doesn't necessarily apply to software engineering, but it's that you're farther from the money spigot. You can make a lot of money in finance or in sales because it's very easy to say, I created this much value, I get X%. So if you're in sales, usually you get 10% of what you sell. So if you go sell a lot, you can make $1 million a year. You can make more than the CEO because you're like, look, I contributed all this, give me a cut.
No, I'm laughing at myself because I had a friend of mine back in college. He was a little older than me, so he was like maybe in his late 20s, and he was a mechanical engineer, and he just grew tired of it and just this kind of like mediocre salary, and he went and sold cars, loved that, and moved up to be a GM of a dealership, probably making $1 million a year, $750,000 managing a car dealership, and he's a mechanical engineer.
Yeah. Clearly, society values that skill more than a mechanical engineering skill. And so, go where you're treated best, as they say. So
maybe it's another, thing like with teachers, right? How teachers are really important, but somehow they just aren't paid like they are in like Finland and Sweden and other countries like that, where they're highly valued and it's very prestigious. And here it's like, oh, well, you're kind of doing that because you love it, right? Well, maybe like engineers kind of like that. Oh, you do that because you love it, right?
Very similar. You're right. It's probably especially hard for teachers because they have to get an advanced degree to do it in most cases. And then once you're in that, what career can you switch to that pays more lucratively?
You're locked in. Yeah.
You're kind of locked in. At least within a lot of these STEM degrees, like mechanical engineering in my case, at least, a lot of like financial firms like kind of that technical background, they'll maybe hire you to bring you over. You can kind of teach yourself to do software engineering. You can jump over to that. But coming from a teacher background, it's probably much harder to make a high paid jump like that. And it sucks. They do create so much value in our society, and we don't.
And then so you go to Stanford, full-time, couple-year program. How did that shape your perspective coming out? What did you do next?
It was fantastic. I met so many interesting people. Really expanded my perspective. I saw you went to Haas. I'm sure had a similar experience to you. It's really
amazing. Yeah.
It's great to kind of take your mind out of kind of being in the weeds where you're working on the day to day and just kind of learn about all these bigger, broader topics.
World of possible.
People from all these different backgrounds.
Yeah. And everybody's in the same point of their lives as you, all looking to do the same kind of stuff. Yeah,
absolutely. So it was great for expanding my perspective. So I did 1 year at the GSB, ended up starting a company during the summer in between with a classmate and a guy from the medical school. By the end of the summer, we got a term sheet from Kleiner Perkins, and we're like, this is awesome, good opportunity. Let's all drop out. And so we dropped out of school, pursued it. And that one was an absolute disaster in every possible way. We got a good start. We raised the money, built the team, launched the product, but we just couldn't find product market fit, and we had tried pivoting all these different times. We had a lot of infighting in the founding team. And the funny thing is, even though that was probably actually the hardest experience of my life professionally, I learned way more from in that 1 year or 18 months with that failed startup than I did with my success with iRhythm. So even though it really sucked, I'm grateful I had that experience, learned a ton, and Stanford was very nice to welcome me back the year after, and I was able to go and do my same.
Oh, and go finish. Amazing. That's what's great about Stanford is they have that open door policy. You can kind
of. I hear it not anymore, but
oh, really?
They were very nice to let me in.
Yeah, because I think a lot of the tech transfer, they'll let you go kind of try to productize it and create a business around it. And if it doesn't work out, just come on back and finish your graduate degree.
Yeah, it was great. I felt like I got to go get more business experience. When I came back for that second year, I felt like a lot of what I was learning in the classes was like so relevant to what I had just been through with the startup. And so it was really good.
That's amazing. So Kleiner gives you guys a term sheet, some students at GSB, pre-launch, pre-revenue. Here's our idea.
Yeah.
Amazing. Like, what was the terms of it?
Yeah, it's crazy. Terms were pretty different back then. And I think also maybe it might have been a little bit under market then, but basically they offered us $1 million, $1 million pre-money. So they wanted half the company for $1 million.
Wow. And one on two or one on one.
Or one on two posts or
But it's Kleiner.
Yeah. So, huge. I mean, that really helps make the decision to drop out of school. And, it's like, it kind of gives you a credential in itself. It's like, okay.
Wow. So high risk, high reward for them, I guess, is the calculation. Like, here's a really interesting team with a really interesting background. That's wild. And so you roll that up.
Yeah. So we shut it down. We negotiated them up to 2.5 million posts. So we only had to give them 40% of the company for $1 million. It's so different from nowadays. Like every now and then we are able to invest at kind of a 1 to 3 million valuation, but it's a very small amount, like maybe 25, 100K or something like that. So that they can kind of like, get a little bit of a proof of concept. But I
don't like to invest at that valuation, because typically what it means, unless it's like a really amazing team, I've done it on a select few, but I mean, you're basically taking a huge risk on the team, right? Because they're pre-launch, pre-revenue. They very much are at the idea formation kind of stage. Maybe they're not even incorporated. So now they have to go out and get incorporated. It's like, and now you're investing, 25K at a 2 or 3.
Yeah. Yeah. So those are rare today. But it's funny, you hear the stories from back around that time period. So this was, I think, 2011 that we did. Airbnb did their first round, and I think it was 2009 at 2.6 million posts. So, and that was Sequoia that put in $500,000 on that. So it's like, those were the valuations then for a first round. I heard, so Uber also, their first round, Travis Kalanick and the team was very experienced. They had successful startups under their belt. That was $5 million per year post.
I think it was 5, yeah.
That was high. Clout, which was kind of a somewhat successful.
Jason Calacanis invested in that round, right?
Did he really? I had no idea.
Yeah, I think the little VC joke.
Yeah, for sure. But no, it's just valuations were so different then. And now it's like, gosh, every single company coming out of YC, often with just an idea or like 10K of revenue, they start at 20 million posts, which it's nuts.
It's all 20. We have a YC focused fund. So we're in the process of right now, as we record this week, meeting all of them, because the game on the field, of course, is you have to meet them before demo day, and all 2 on 20 coming out.
It's crazy.
Yeah. But they are really amazing teams. What I like about meeting YC, and maybe we'll get into the founding of Unpopular, is it sets the bar really high for everybody else I meet. Because we have 2 funds. We have the seed fund and the YC fund, right? And the seed fund is just broad, worldwide, pre-seed, seed, B2B software, fintech AI marketplaces. And then I go meet those same companies in YC. And the valuations are super high. Instead of 5 and 10 caps, they're 20 and 25 caps. Teams are just really, really, really good.
They are. And they are more likely to succeed. I don't know if it's the selecting, the coaching, the network that they develop. But literally all of our best investments are YC alums.
Really?
We didn't plan it that way. And we probably do about half YC, half not. But all of our best ones are YC companies.
We're about half and half. Yeah. And the trick, like, how many do you invest in per batch?
It depends. My partner, Thibaut, is really our kind of YC magician. So I do a few here and there. He is very good at going through the whole list every batch and kind of cross-referencing the LinkedIn profiles and like researching them and kind of deciding which ones he likes and reaching out to them. So he'll kind of go rapid fire through. I think
he's an alum of YC.
He's not.
Neither am I. I'm just a guy that admires YC, just reaching out to YC founders. Usually I'm able to get on the cap tables because of my background. I think in the future for Team Ignite, we'd probably have an alum that can go to an alum demo day, which is a couple weeks before the broad public demo day. But tell me about the founding of Unpopular. So you come out of GSB, what happens next?
So made a couple different stops. I had a short stint at GE Ventures, which doesn't exist anymore, but it was General Electric's venture arm at the time. Very quickly realized that it wasn't for me. I spent like 11 months there or something like that. And it wasn't even just that I didn't like it. It was, I very quickly realized that I didn't believe that corporate venture made sense as a thing that should exist. Just, I saw a huge incentive misalignment between, it's the purpose of corporate venture these days. It's like the corporation wants some strategic value. They're like, okay, we want this to inform our businesses, our own business units, but also it'd be nice to make some money by investing in these startups, and that'll do well. Everyone kind of knows if you optimize for two different bottom lines, you usually end up doing neither one very well. And venture capital in particular is very, very hard to just make money on. Something like half of funds either don't, it depends on the vintage, but either don't return the fund or underperform the public markets. So it's very hard to do venture well when you're just trying to make money.
The double bottom line, which is like, okay, we're going to make these strategic bets that give us kind of sight into innovation, but also we want a return on our capital. And this was the identity crisis at Microsoft. When I was there, they were going through an identity crisis of they were investing off balance sheet into a bunch of random opportunities, trying to get returns. Kind of like maybe 2 or 3 years ago, they kind of revamped that to be more strategic. Let's actually know we have these like 14 buckets that we care about, cybersecurity and et cetera. And we're going to go invest in those areas because those are the areas we care about. Yeah, we want to get a return as well. But before that, they're investing in like electric helicopters and just all kinds of random stuff.
Yeah, it's amazing. So it sounds like you kind of observed the same challenging dynamic.
Yeah. And then so you're at GE. The CVC is not for you. And then what's next?
So yeah, around the same time, I'd started to dabble in angel investing. A couple of years before, I'd done a tiny personal check into a friend's company. It's called Chubby's Shorts. They actually ended up doing very well. Got acquired at a good multiple. It was kind of a men's clothing brand.
Oh, wow.
Did another investment the next year. That one also got off to a good start.
What year is it?
That was 2012. 2012 was my first check. Very small. And I only did it because it was a friend. Did another in 2013 in a GSB classmates company. And then when I was at GE Ventures, I kind of started to see more and stuff that was not relevant to GE. So I did 8 personal investments that year. And I was loving that. Hated the corporate venture. Decided to leave that. And I was just like, you know what? Feels like this angel investing thing is fun. It's working for me so far. Decided to lean into it and try it out full time. Ended up doing it for 5 years on my own. Got extremely lucky there in large part because I went down the crypto rabbit hole in 2015.
Oh, wow. Well, it's a good time for it.
It was a very good time for it.
Yeah.
Part of it was I'd invested in one friend's startup that was kind of trying to do something related to crypto. He kind of explained it to me, and then I read more about Bitcoin. And I ended up allocating a big chunk of my personal kind of fund that I kind of fenced off as my angel investing fund and put it in Bitcoin.
Oh, wow.
And ended up with a very high multiple fund in a short amount of time that was liquid, which meant financially I could keep investing, could keep supporting the family.
Amazing.
But also I told everyone that I knew pretty early on to buy this, and basically nobody did.
This is back when it was like about $200 or $300 a coin.
Exactly.
Right?
Exactly.
I remember my engineering friends. I'm sitting down in Seaport, Redwood City, product manager, getting my MBA because I did the part-time program. And my engineering friends, I was product manager, and they're like, "You should probably look at this Bitcoin stuff." And I think I remember it being like $250, $300. I was like, I don't know if that's going to work. And yeah, boy, was I wrong.
Yeah. So anyway, yeah, it returned my fund many times over. And by the way, for anyone listening publicly, I lost it all in a freak boating accident. I don't have any more. And the reason I'm saying this is that I've been the target of hackers in the past.
Oh, because they know how they assume you have like millions and millions of dollars of Bitcoin. And so they're trying to get it off your machine.
Exactly. So publicly, I don't have any.
Wow.
If I did, it'd be in geographically distributed multi-signature cold storage. Very difficult to access. Please don't bother me.
Please do not bother me. That's crazy.
No, back in like 2017, 2018, I was the target of this type of hack that was happening a lot called SIM swap hacks, where they basically figure out how to port your SIM card and take over your two-factor authentication and take over your email and Coinbase account. It was such a nightmare.
Oh, no. Yeah. So, and so now you're afloat with this Bitcoin, which you don't have anymore. And then, and what was kind of the founding around Unpopular? How does that reflect your investment?
Yeah, so all these people I had told to buy it early on didn't, and a few years later they all came back and they're like, "Dang, I missed out.
You're right.
What are you investing in now?" And that helped me start Unpopular Ventures. And I started in 2019, about the same time as you. I think I saw you started in
2020 for us. Yeah. I was got angel investing for a couple of years like you, but I started like in 2017, 2018 on my own with my own cash and LP in a bunch of funds. And after a couple of years, I was like, I really like this. How do I do more? Team Ignite.
Totally. And I imagine I had a similar kind of start as you. So I basically tried to raise a conventional fund, wasn't happy with how much money I was able to raise in that,
Really?
especially from conventional LPs. One of the pieces of feedback was that, okay, you've done well as a solo investor, but it kind of doesn't count when it's your own money. We want to see that you're
You can
putting
be a
out these
good
results with
steward of other
people's money.
people's cash. Yeah.
Exactly. So I went and started doing syndicates on AngelList. And it was just
And
incredible
that's originally how
how,
we ran into each other, was on AngelList, I think. Yeah.
yeah, that
Yep.
makes sense. I met so many great people there. So started doing SPVs. And it's just amazing how fast I was able to move really meaningful money thanks to AngelList. The first year, we invested about 5 million. The year after that, we did 12. And in 2021, we did 20. It's come 2021 was a hot year. We do less per year now, but yeah, it's funny. I went out originally to try to raise a $20 million fund, fell flat, and then it's like within just a couple of years, I was doing that every year in SPVs.
Yeah.
So,
In hindsight, that's interesting. So were you able to raise any money back in 2019, 2020 for your fund, or you just started doing it? You're like, this is going to be too hard.
yeah, all these friends were like, okay, I'm in for like 25K, 50K or whatever. I couldn't get past 2 million of commitments.
Yeah. But on my first fund, so like you, I did syndicate investing on AngelList for the first couple years. Then I had a rolling fund for YC startups, and then I went through VC Lab and did a more traditional raise. And this is like late 2022 when the sky was starting to fall, and I had 1.5 million commits in my seed fund when I went to close in December. Probably the worst time to close a venture fund in the last 20 years, maybe since 2008 or 9. And half of my commits fell out, so I closed in 710,000. I remember that was my fund when I got started.
Good
So
on you for taking it and going and doing it. And
then I just kept grinding for 2 years and got it to 5. But it took 2 years of grinding.
Yeah, I hear you. I mean, it is actually amazing how most of the really big venture firms now started super small. Like, I saw Kleiner and Perkins' first fund was either 4 million or 8 million, something like that. NEA was very small. Like most of these started in single digit millions. Or I think Kleiner and Perkins was 4 million fund one. Chris Sacca's fund was 8 million.
Well, Chris Sacca hit that. That's the fund that went like 110x, right? Because he hit 250x in one fund. Because he hit a bunch of decacorns, like Airbnb and
I don't think he was in Airbnb. He was in like Instagram and Twitter and Docker, but Uber was really the big one.
Wow.
But yeah, that is considered the best performing venture fund of all time in terms of multiple.
That's insane.
But yeah, it was small. So it's like all the good venture firms start super small. You just gotta get started. And so good on you for taking what was on offer and getting going, and you've grown since. So congrats.
Yeah, no, it's a grind. So are you currently still just doing SPVs, or are you guys investing out of a fund now, or what's the?
No, so we have a rolling fund too. I really love everybody that I meet through AngelList. I feel like AngelList really helps us scale much more efficiently than me flying all over the country, all over the world to try to pitch like various family offices and stuff like that. So people find us through the syndicate, and then some of them join our rolling fund as well. And so our rolling fund is about somewhere around like 4.5 or 5 million per year right now. Yeah, I feel very lucky.
Yeah, I mean, so for listeners, that would be equivalent of having roughly a $15 million fund, which is a very sizable fund. You can do lots of checks. So what's your check size? What's your thesis? Like, how are you guys managing that money?
Yeah, so similar to you, we do very high velocity investing. Thanks in large part to my partner, Thibaut. He is very good at sourcing just tons of really high quality companies and getting pretty small checks into them. So he and I together do a lot of 25 to 50K checks out of our fund. It's about 100 to 150 a year. For a couple of years, we're doing 150 a year. Last year, we did about 100. We'll probably do something in that range this year.
And why such a high velocity of checks?
We see a lot that we think is really compelling. It's a lot easier to get a small check into a company than a big one. We've developed a pretty good reputation. We look good on YC's book face. Other founders say good things about us. So there are a lot of people that are just happy to have us in their companies. And sometimes we can move more, and I'll talk about that later, but it's just very easy and quick to get 25 to 50K into a lot of these companies. And because of the power law nature of venture investing, for the size that we operate, that can turn into a lot. So, an example of a company that we only did 25K into, we wanted to do more, but they took our 25K, and we're grateful that they did, is Zepto. So we invested in them in their very first round during Y Combinator on 13 million post. They last raised at a $5.8 billion valuation. Only I think it's like 3.5, maybe 4 years after our investment. It's up over, I think, 86x on paper. So that 25K is already something like 2 million. Our whole fund that year was 3 million. So already in a short amount of time, because of this crazy multiple, that supposedly are going to go public later this year, it'll probably be at an even higher valuation. We'll return the entire fund, or the entire vintage of 150 investments with that 125K one in a pretty short amount of time.
I share a similar sentiment as I think about portfolio construction, dollar cost averaging, hitting the efficient frontier of the asset class. Like when I approached it, I very much had like my CFA brain on, because I'd worked on Wall Street, finance degree, CFA, all that stuff, and which I hated, by the way. But when I looked at the asset class, I was like, okay, what's the efficient portfolio size?
Mm-hmm.
Where do I hit? Like, where do I maximize my chances of gain and minimize my chances of loss?
Mm-hmm.
And if you do the research for pre-seed and seed, it's like 100 to 150 startups in your portfolio. That's kind of the sweet spot. And so I've kind of we both independently kind of honed in on the same strategy, which is about 100 to 150 a year across my two active funds. So about 50 per fund over 3 years. Over a 3-year fund is 150. And, time will tell. But like other folks I talk to in the industry, Right Side Capital Management is a good one. I think Ron Conway, 20, 25 years ago.
They do a lot. Yep.
Soma Capital, GC.
I like them, and maybe 500 startups was kind of the first. Or they're like
500. Their first fund did 500 startups, and it's like 11x net.
That's amazing. Totally.
That's an amazing return. That's a top, 3%, 2% return for a fund. And so that's what I tell my LPs is like, I can be wrong a lot with my strategy. I can be pretty bad at investing even. And if I invest in 150 startups over 3 years, I'll probably have a pretty good fund. And not only that, but
you will.
I'll make a lot of mistakes and I'll learn faster, right? Because I'm swinging the bat more. I'm stepping up to the plate more. I'm getting on base more, and I'm just learning a lot. And I think it's not the only way to do venture. There's certainly like you could just do a seed and lead, invest in 15 or 20 startups and take a board seat and.
Mm-hmm. Totally. And like, I'm a big believer also that a lot of the failed investments lead to the good ones too. So there are a lot of cases where, we'll invest in a founder, he'll fail within a couple of years, and then he'll go start another one and he'll invite us to invest, and then that one will do well. Or also we're investing in a lot of founders where they introduce us to all their buddies that are raising money. And so
it's a network kind of play.
Yeah. It pays dividends to invest in more companies.
So can you share a story? Yeah.
I was going to share a couple statistics or a couple thoughts on the large portfolio thing. And there are a few additional things that I think support investing in more companies. So the first is the median venture capital firm or fund dramatically underperforms the mean one. And the reason for that is that there's this power law where it's basically the top 10% of funds produce almost all the returns, and everyone else is pretty lackluster. And so a lot of these firms are trying to invest in 10, 20, maybe 30 companies, and a lot of them don't get lucky and don't get a winner. They don't get one of those companies that's driving all the returns of the industry. And by making more investments, you get closer to the mean returns of venture capital, which are quite good. The mean returns of the industry are high teens, maybe even 20%, depending on the vintage.
Well, yeah, I've even seen stats around B2B software where it's 25% for early stage.
Yeah, could be.
Yeah, pre-series A. Yeah.
But then conversely, the median firm, if you kind of stack them all up on returns, the one that's in the middle either has negative returns or like doesn't even beat the
roughly 2x, let's call it. Yeah, they're just hitting maybe the market return. Like you might as well.
Some vintages they don't even get to 1x. They don't even return all the money that was put in them.
That's crazy.
So it's like if you're trying to limit your checks, you're more likely to be a median firm than you are a mean firm. So anyway, that gets you more towards the mean. And then the other thing that I always like to highlight is it's so funny how like different words have they mean the same thing, but have a different vibe to them. So like there's some words where, if you call somebody cheap, that means they spend little money and it means it in a negative way. Whereas if you say they're frugal, they still spend little money, but it's a positive attribute. And so in the same sense, the term that is often used to deride people who invest like us is spray and pray. And the positive version of that term is diversification. And people think it's such a smart financial move to invest in the S&P 500, where you're investing in 500 big public companies, and that's so safe, and you're going to get good returns doing that. So then why isn't it a smart financial decision to invest in 500 carefully selected startups? And it's only in the semantics.
Exactly. Yeah. And so I have multiple slides on this to educate my LPs. They'll be like, oh, I'm going to go with this other fund. I'm like, great. Tell me about their thesis. Oh, interesting. They're going to do 15 startups in their fund. Cool. How's that going to work out? Here's the statistics on this, right? Here's some Monte Carlo research. If you were just a, monkey throwing darts at a TechCrunch, just open up the TechCrunch every day, throw a dart at it. You'd have to print it out, I guess. Don't throw it at your computer screen. And if you just did that every day, for 600 days, like 600 working days over 3 years, you would have a really, really good fund.
Totally.
And and that's if you're bad, if you're just random, which I don't think you and I are just random. We're meeting I'm meeting I don't know about you, I meet 200 startups. I look at 200 decks for every company I invest in.
Amazing. That's a lot.
Yeah, that's a lot. So that means like I do about one a week. That means I'm looking at about 200 deals a week. And sometimes that's like, 30 seconds. Sometimes it's 5 minutes. Sometimes it's a call. Sometimes it's 2 calls. But, it's a lot of work.
And the thing is, there are actually structural reasons why the industry gravitates towards a more concentrated portfolio. And I can explain what it is.
Oh, yeah.
So a lot of the firms that invest in kind of new managers are these funds of funds. So funds of funds that specialize, so they basically raise money from LPs and they're going to invest only in VCs and some will even specialize in emerging managers. Their business model is to charge a management fee and carried interest on the fund. But then when they invest in these VCs, they basically have to pay fees to the VCs as well. And so what they pitch to their investors is, okay, we're going to deploy part of our fund into these managers and pay them their fees. But we expect that someone like in their winners, because these funds are small and concentrated, they're going to have these winning companies and the firm is going to run out of cash to do their pro rata. And we're going to then hand select their best companies and we're going to take over the pro rata for them. And we're going to invest directly without fees. That only works if, one, the firms have big ownership and therefore the fund of funds can get immediate pro rata in the subsequent rounds. And two, if there are a relatively small number of companies to keep track of. If each of their 20 firms that they invested in has hundreds of companies, how on earth are they going to keep track of all these? And then the pro rata, if they're doing 25K checks or 50K checks, like how much is the pro rata really going to be worth? Like they can't move the money. These funds of funds are actually effectively doing what you and I are doing, building a big portfolio. But they want to kind of have control of
1
it.
in 10 on top of our hard work.
Exactly. But to get started and build that big firm.
We love you. Invest in our funds.
But yeah, if to get started, those are the main people you can raise capital from as an emerging manager. It's basically them and family offices. You can only get to the big institutions if you've already done several funds from these smaller LPs.
It's something I'm struggling with right now as I kind of enter our 4th fund later this year. I'm raising my 3rd fund right now publicly, so I can talk about it, the YC Fund 2. Little $10 million vehicle. Fundraising's slow, but we're chipping away at it. We'll probably end up close to 10 by the end of the year. Writing a high volume of 25K checks into YC companies. Nothing wrong with that, as we've discussed. But I'm kind of struggling with this kind of Fund 4. What does Fund 4 look like? And so far I got 2 YC funds and a seed fund. And so what I'm thinking is like just pull a Harry Stebbins 20 VC and just skip the $15, $30 million fund and just go 100. We have 200 startups. We have a bunch of markups. We have the track record. I have people in place to grow the team and just go out big. And I'll just skip that whole mess of the fund of funds family office thing and go straight to institutionals.
If you can do it.
Maybe it won't work. I don't know. But
it might. It seems like the market might be starting to warm up a little bit. I know it's been really hard for the last year or two.
I might be timing it correctly in 2026, I think. This episode of the Ignite podcast is brought to you by our friends at Build, spelled BYLDD. Build is a development agency that specializes in helping early stage startups, especially non-technical founders and teams, build and launch scalable revenue generating software products. Most startups don't have $100K to hand over to a big agency, and honestly, for your first product, you probably shouldn't. Sure, you could try rolling the dice on some freelancers, but that's a gamble with unclear costs and a lot of project management headaches and no guarantees. That's where Build comes in. For just $10K in about a month, Build can turn your validated idea into a real product that's ready to go to market. It's a smart, efficient way to build a foundation for a company of any size. And yes, companies that start with Build can and have scaled very large. Their clients have gone on to be backed by YC, Y Combinator, and Google, and raise funding at multi-million-dollar valuations. Ready to get started? Head over to build.com. Again, that's BYLDD to connect Ayush and the team and let him know you heard about Build on the Ignite podcast. I love this conversation because we're birds of a feather, but maybe you could share a story of a portfolio company where you took a non-consensus bet that paid off.
Sure. Okay. So one challenge we have is some of our best companies, we're not allowed to talk about them publicly. So I'll skip those. It's just, we have a couple companies in particular where they're doing extremely well. They're the only ones in their market. And they're deathly afraid of anyone noticing how much money they're making and coming over and trying to compete with them.
Right.
And so they're like,
which is the challenge of running a syndicate, by the way. I mean, you're basically uncovering why I got out of the syndicate game as soon as I realized this, which is the best deals you can't syndicate oftentimes, right? They're just like, we only take money from funds. Why is that? Well, they don't want their information out there to thousands of people, all public. Here's exactly how we're doing. Here's how the business works. And for good reason, right?
Yeah. It's like they have to go public kind of very, very early before they're
it's kind of like going quasi-public. Yeah, because all that information wants to be free. And so if you just put it out there on AngelList, People are going to see it.
For sure. So I'll pick a company that I can talk about, or I'll only share public information. So I'll focus on this company called Yassir. It has grown into basically the leading super app in all of French-speaking Africa. And by super app, I mean, so a difference in a lot of emerging markets, first the US market. So in US markets, if you start Uber or something like that, you kind of have to focus on that. Maybe you can expand a little bit to like food delivery with Uber Eats or stuff. But you kind of have to stay in your lane because there's so many really strong companies to compete with in all the different verticals that are out there. Now, in a lot of emerging markets, say, I'll say like Indonesia, for instance, there were almost no tech companies serving the local community in an effective way. Like maybe they kind of had Google, or maybe they could sort of get on Facebook, but it's not, in the local language or translated properly or kind of fits the cultural norms. And so oftentimes in these emerging markets, when a tech company is able to get traction and start making money, they find that there is no tech company serving all the other things that in that economy. And they can basically become the big tech company in that region. So what happened in Indonesia, for instance, there's a company called Gojek. They have a different name now after a merger or something, but basically they started with, I think it was food delivery on motorcycles. So people would use their motorcycles to deliver food. They then realized they could give rides and do it in cars. Then they realized, hey, people aren't delivering packages effectively. So they became the FedEx or UPS of the region. And they basically continue to add additional services, and they become literally the big tech company. And that's what's called a super app in the region. So similarly, my partner, Thibaut, found this founder in Algeria who was creating basically the Uber of Algeria. A very smart guy, great track record. He's a Stanford PhD, had been an executive at Intel for a long time in the Bay Area, but he was from Algeria originally, and he wanted to go back there and start a company. And so he actually put $1 million of his own money to get it started. They got incredible traction off just his money and his own efforts, where when we saw it, they were doing something like 20 million of annual GMV or basically sales. Something like 4 million of net revenue, growing very fast. And he had an impossible time raising money. Before him, there had been no company from Algeria that had raised venture capital from outside Algeria.
It's unpopular.
It was very unpopular. But my partner brought it to me, and the guy said he'd take money at a 15 million pre-money valuation with 22 GMV. So a huge amount of traction. And priced at less than these YC companies that have an idea. And
they have 5 customers, paying them $1,000 each. And they're all YC companies. In their batch.
Yep, of course. So anyway, this is actually the first deal that my now partner, Thibaut, brought in. Put together a syndicate, put it up on AngelList. And I think we got it was like $440,000 from LPs on AngelList for
That's
that
a big
one.
syndicate.
It's really popular. People liked the traction. They liked the founder's background. And so we got a lot of money. So we were... So
this 20 million in GMV, you said?
Yeah.
Wow, that's a lot.
Yeah,
and what was
really
the take
crazy.
rate?
So I think it was like 15 or 20%. So what I remember is their revenue was effectively 3 or 4 million, something in that range.
Nice.
Yeah. So it was the first company.
That's a lot for a 15 cap. Yeah.
Oh yeah. No, it was a ton of traction. Yeah. And especially with that founder background. And he had all the skin in the game by investing all his own money into it. He was really all in on it.
How do you feel about that? Typically when I see that, it could be a big pro and a big con. Like it depends on the quality of the business. Like if the business, like he puts $1 million in and it gets to 20 million in GMV, that's a really positive sign. He put all his chips on the table and went all in, right? Mm-hmm. Versus like I've seen founders where, they burned a lot, right? They've burned a lot and have nothing to show for it. I'm like, ooh, that's painful.
Yeah, it's a great question. So I will say we definitely don't require that in any of our investing. Most founders...
It can be a negative signal most of the time.
It can sometimes be a negative signal. You're right. But in a case where it's worked, where he bet on himself and like he had the success, he had the money. I usually when I see someone who has had financial success in the past, I do ask, have you invested in your own money? If they haven't had success, if they don't have any money, I wouldn't expect anything like that. But if they have, it's like, okay, how much do you really believe in this? And I think it's usually a good sign if someone who has been successful before has invested some of their own money.
I would love that for Team Ignite someday. Yeah, we're raising $1 billion fund, and I'm putting up, most of it.
Right. Yeah. Right. It's like the GP commit, right?
Yeah. The GP commit is 50%.
Yeah. Right. No, some people do that, and I think if you can do it, it's awesome.
Yeah. Totally.
So
I've heard of this app, so it's doing well. Like, how's it doing now? What year was this that you guys did the SPV? And So
it's 2019. So they have grown dramatically. Yeah. So I won't say anything non-public, but they have a lot of revenue, a lot of GMV. You can go on LinkedIn. One way that you can often tell how well a startup is doing, and it's not always true, but it often is. So you can go on LinkedIn and see what the employee count is and see how it changes over time.
And LinkedIn gives you, if you have sales nav, it'll give you like a revenue estimate too. I don't know where they get that, but
Well, really,
it'll be like, okay, they
I
have
should get that.
between 50 and 200 employees and 5 to 10 million of ARR. It'll kind of give you like estimates. Directionally correct, but not, deterministic data.
Yeah. Right.
Nice.
So yeah, according to LinkedIn, they have over 1,600 team members. And I think that undercounts it because the company's headquarters is in Algeria, where probably a lot of people don't use LinkedIn.
Right.
But yeah, they're doing great. They've taken over both that country and the countries around it as kind of the big tech company there.
Amazing.
So they're doing well.
That's an unpopular bet.
Yeah, it's a good one.
Because I think what's unpopular about it is if you look at it, you're like, okay, has there been anybody successful from that region, from that country with this idea before, right? Because so many investors kind of look for analogies. Like, oh yeah, it's another marketplace app that does this thing in San Francisco.
Yeah.
But a lot of times, I think what I've learned, and I'd love to get your take on this, over 170. So you've done 450, you've done 3 times more than me in almost the same period.
Me and a partner.
Yeah. So okay. Well, don't discount my experience that much, I guess. But what I've kind of learned, and I'd love to get your take, is a lot of what makes a great investment is like its uniqueness almost. It's kind of like, what is the unique take about the team, the market, the timing, the tech, like all those things. I'd love to get your take on, after 450 investments, what you've learned. What are some key qualities you look for, rules of thumb, yellow flags, red flags, all that stuff. And you write a lot about this on your blog, by the way. So I encourage everybody to go read that.
Yeah, really appreciate it. So in regards to kind of this specific company that we're just talking about, the thing that I would highlight is the number of risks you're willing to take on a company. When you invest in the US, for instance, or especially a company in Silicon Valley, you know that the market of whatever anyone builds is very big. I mean, the US is the biggest market in the world, and particularly for like B2B software, like Silicon Valley is the best market to be selling that. But you also know that everything easy has already been done. So pretty much anything that is going to be successful from Silicon Valley has to be a new idea. And so I am very willing to take a risk on new ideas if I know the market is going to be big. So we invest in a lot of new ideas when they're US-based companies, because we're now going after the US market. If it works, it'll be huge. Now, when we invest in emerging markets, so about half of what we do is outside the US, and particularly in emerging markets. So we do a lot in America, Africa, Southeast Asia, and beyond. We do Europe too. But that's not emerging market, of course.
For tech, it kind of is.
It's hard in Europe. So maybe it is kind of like, but yeah, you're right. But
usually about 5 years behind in my experience. Like there's companies working on ideas that came out of Silicon Valley 5 or 10 years ago.
You're right. So actually, this is relevant for Europe as well. And it's that, so if we're going to take a risk on a weird geography where the laws are different, we don't know if the market is super big, the government might nationalize the company next year. You never know. We don't want to take geopolitical risk and new idea risk at the same time. And luckily, in a lot of these markets that are outside the US, they can look at what has been successful in the US already, copy that, customize it for their local culture and language and all this stuff, and be extremely successful and build a multi-billion-dollar company there. And so the way that we invest in a lot of these emerging markets is distinctly different. It's in many cases copycats of what has been successful in the US, because we don't want to take that
idea risk. The rocket internet
but
strategy is what I call that, right? And they've made billions and tens of billions of dollars just copycatting successful Silicon Valley startups. Do you have any stories like that from your portfolio where, like, I guess the super app is kind of a version of that, but anything and like for me, I was in Venmo back in the day. That was Bill.com in Southeast Asia. It's kind of a copycat, right?
Yep. Absolutely. So
a bunch of my own money in that.
Yeah, for sure. So Zepto in India is that. So they're the Instacart of India. And now they've expanded. Now it seems like they're kind of almost like the Amazon also of India, and food delivery. So like Instacart, DoorDash, maybe Amazon, and other things too. Yeah, it worked in the US and it seemed obvious that it would work here too.
Yeah, I love that. What are some other key qualities you look for? So don't want to take too many risks all at the same time. New ideas in existing, established markets like Silicon Valley. It could be a copycat idea in a secondary market, we'll call it, or a follower market. What else do you look for? What are some rules of thumb?
So
teach me investing, Peter.
No, I have a lot to learn from you too. But I mean, really a big one that is kind of not negotiable for us is just founder background. So, this I think is kind of an unpopular view. Culturally, in the US, maybe the world, people like to believe that anybody, if they just have the right idea and they work hard, they're going to be wildly successful.
It's the American dream.
That is the American dream.
Yep.
My unpopular view is that it's extremely rare for someone to go and create a $10 billion plus company when there were not hints about their talents before that. No one came from nowhere, never built anything before, never had any exposure to Silicon Valley, and boom, $10 billion
Yeah.
company. There's always
Zero to hero.
this
There's
track
no
record.
zero to hero. There's some leading indicators. Either you got into a great school, or you had a 20,000 per month revenue business when you were 14 out of your
Exactly.
parents' house.
Entrepreneurial track record.
There's something there about your background that either like echoes, it foretells success in some way.
Exactly.
Yeah.
Even Mark Zuckerberg, he was very young, Harvard dropout, but more importantly, he was shipping these viral apps to Harvard. Like there's something that he did, like Hot or Not, which took the campus over. He was clearly building from a young age, creating these super viral popular things, and Facebook was just his next one. And so we're happy to invest in young people. You don't have to have like work experience necessarily, but we want to see some sort of track record that's like, hey, this person is exceptional, and they seem likely to go and do great
They're
things.
exceptional somehow, right? You're looking for hints of exceptionalism.
Exactly.
Like we just invested in this company, or made an offer to invest in this company. It's 3 students, all dropped out together from Carnegie, CS students, or YC company, name names, I guess. So hopefully we get on the cap table, but just been building, since they were teenagers, just exceptional kids, right? 18 years old, 3 18-year-olds.
Wow.
But they're just exceptional. There's just like so much exceptional there. Yeah, I like that.
Oh, that's so cool. Yeah. Great for them, and it sounds like a great bet for you.
Yeah, well, I mean, we'll see. It's an easy bet to make, I think, in that case. But I love that. That is, I kind of have the same opinion. I think I say it in a different way, but yeah, I think that's something that we agree on as well. What about some red flags? When you see something, you're like, ooh, not going to do that one. Yeah.
Actually, before the red flags, I'll expand on this a little bit. So you can do these exceptional things in this first company you're starting to. So it's okay if someone hasn't done anything extraordinary before their company. But if they've been able to kind of build something and get customers and get it off the ground and get this incredible traction with maybe very little funding or no funding, that's an example of exceptional track record too. But it's very hard for someone to have no background, haven't actually built anything yet in their company or sold a customer, and then come in and raise money for us just based on an idea. And that's a funny thing. I feel like so much whenever I'm at a party or dinner or something and someone finds out I'm a venture capitalist, they're like, let me tell you my idea. Or, what kind of ideas do you
I don't
like?
even go to parties anymore because of that.
It's very frustrating. I hate it when people...
I want to control everybody I talk to, over Zoom and the podcast. It's like going to a party is like the worst.
Totally. Yeah. Maybe I should make up what I do so that people don't have to...
Yeah.
Don't pitch me on their idea.
I'm a dentist. Now they'll probably tell you about, like, can you look at this? Yeah. We'll come up with with a profession.
Yeah.
That's really
so the thing is, so little of my investment decision is the idea. I don't even look at the idea in most cases. I look at, what did the founder do before? Does this person seem like someone who's going to build really amazing things? And I also believe that the vast majority of our investments at the stage we invest are going to evolve their idea dramatically as they get out and interact with customers. And so,
especially in that first, 100K of ARR, you're probably going to pivot.
Yeah.
A lot of times we won't invest till 20 or 30,000 a monthly revenue, unless it's at a very exceptional founder, like you're describing.
Right, someone who has maybe generated that or more in a past.
Yeah, they exited their last startup, or they built something as a teenager, like we mentioned. There's just something there, right? There's a chip on their shoulder, right? There's the force is strong. Like you beat them and you're like, wow, I'm just impressed.
For sure. So you're asking about red flags.
Yeah.
I don't know if there's any sort of...
Yeah, like you see them and you're like, nope, not going to do that.
Yeah, just zero experience in startups or building anything, or entrepreneurial experience, stuff like that.
So founder market fit in a way, or founder startup fit.
Founder experience. I want to see kind of a track record of success.
Now that could be
not even success, just track record of like creating stuff and selling it, and that they have a knack for building things that people want. Or I guess that's the YC tagline: build things or build something people want, and just want to see that they're attuned in that way, I guess.
Yeah, I love that. So what's next for you guys? Like, how do you see Unpopular unfolding over the next 5 or 10 years?
Well, just continuing to do what we're doing. We feel very lucky that we've got a lot of really fantastic supporters on AngelList, and we have about 80 or so LPs in our fund who trust us with their money to make good investments.
Your hard cap is 99, I think, right? Unless you go public. Yeah.
Yeah. So it depends on, some of them are qualified purchasers where we can have more of those and stuff. Yeah. But for the ones that are just accredited investors, then the 99.
Yeah, I think
we're under the
QPs, you can have unlimited. Is that right?
2,500.
25, effectively unlimited. I mean, that's a lot.
during the hot years, like 2021, 2022, AngelList had to kind of split our fund so that we could have like the 2,500 limit for the QPs and the 99 in the but people have kind of pulled back in recent years. So now we're only at 80 total, I think.
I love that. Yeah. I mean, if somebody asked me that question, I'd be like, yeah, just keep doing what I'm doing. I love this. Yeah. I mean, if you weren't doing venture, what would you be doing?
I think I would keep angel investing. I do just love it. I wouldn't be the biggest angel, but I just love meeting smart people, hearing about what they're building, and being a small participant in their journey. I'll keep running
I feel the same way
with my partner, and we'll keep doing syndicates for companies that we feel like have a good story.
I like the rolling fund model too. I mean, in hindsight, because once you get up to your scale of it, you can just kind of keep it going. It's like almost like an evergreen fund.
That's right. You're both always fundraising and never fundraising,
and always deploying.
It's never this dedicated time that you say, okay, now I'm fundraising. But I feel like we are kind of, with our quarterly updates, and we do calls with our LPs, we are kind of always fundraising a little bit, but it's not the same lift as raising a conventional.
Yeah, I love that. Why don't we wrap up with a rapid fire?
Okay, sounds great.
What's the most underrated geography for startups right now?
I think the Bay Area, actually. For a while, we were indexing much more outside the Bay Area. Part of it was that the Bay Area companies were all super crowded, super highly valued. Now that kind of all the tourist capital is left, people have pulled back. We're now seeing lots of really talented founders just in the Bay Area that can't fill their rounds, and we're able to invest more easily and at lower valuations, especially than we were able to in like 2021.
Oh yeah, 21, 22 was absolutely bonkers trying to get on cap tables. You had to make decisions within a day, and now you can really stretch it out and be careful. Yeah, it's a much better time to be an investor. Better valuations, all that stuff. What's one sector you think is overhyped in 2025?
So I think AI is currently in the peak of inflated expectations. There's a famous thing called the Gartner hype cycle, where people get very excited about something. And even if it is the future, it's going to take longer. It's going to cost more money. There's going to be more competition than people expect. And people kind of lose faith in it for a little while, and valuations come crashing down. I know this is rapid fire, but I can give an example.
No, let's do it. Yeah.
A great example.
Rapidish fire is what I like to call it.
Okay. Yeah. It's the .com boom and bust.
Right.
So obviously the internet was very important, and it's still here creating tons of value, and more value than was in kind of all the .com companies in 1989. But still, it all got ahead of itself. And so people put in too much money in companies that were not very strong at that time. It all came crashing down. Amazon even, the share price dropped something like 95%. But they got profitable and were gradually growing. And then if you had invested in the trough of disillusionment in like 2002, 2003, you've done extremely well. And so I think that AI is in a similar period where it is very important. It's going to totally change how we live. Everyone's going to be using it in 10 years. I mean, everyone's already kind of using it today.
Oh, yeah, all of us now, yeah.
But I think that I think too much money is getting pumped in. The business models are not as compelling as people think they might be. As an example, everyone thinks software, high margin. Most software companies have 90% gross margins. You kind of mint money with it if you can sell a lot of it. AI at just about every level is pretty low margin. So if you take the LLMs, for instance, you have to spend a lot of money to train the model. They then put it out, and they can charge people money for it then. But because of how much is being invested from all these competitors, it becomes obsolete in a year or two, and then they have to invest all the money again.
AI becomes a commodity like databases. Like there'll be companies that build on top of the technology and make a lot of money, but it will probably be in ways you don't expect. And it's the reason we didn't do an AI fund. I led the AI category at AWS. I built AI for over 10 years. I could have done an AI fund. It could have been Team Ignite, the AI fund. But I kind of I looked at it from an investor's perspective, and I knew that if I did that, I'd be chasing the hype cycle.
Yeah. Right.
And I'd be getting into overvalued companies with very little traction. And I still invest in lots of AI. Don't get me wrong, but it's real.
Selective.
You got to be selective, and it has to be a real business opportunity, not just, some WYSIWYG new AI thing that, was raising on a 200x.
Totally. No, the kind of rule of thumb for a lot of software companies is, well, depending on growth, but maybe on average, they're worth like 10 times revenue. But that's based on the idea that it's extremely high margin. And AI, well, depending on which one, but the LLMs, for instance, might actually be negative margins. It might be for a long time.
It's a race to the bottom.
It is. It's an arms race. Absolutely. Yeah. And so my unpopular take right now related to the LLMs, the model layer, is I actually think that they're going to end up like the airlines, where air travel is also very important. Everybody uses it, creates tremendous value for society. But the airlines themselves are really bad businesses because they're super low margin. They're competing for every little thing.
Every little token. in
Yeah.
the parlance of AI, large language models.
Yeah. But it's
Competing
funny
on
how
cost per million tokens or whatever. Yeah.
totally. And there's a funny thing where you can kind of maybe identify. So within the airlines, for instance, part of why they have a hard time is that they're dependent on individual suppliers that have a lot of pricing power. So they can only get their engines from two companies. It's GE and Rolls-Royce. They can only get the airplane bodies from either Boeing or Airbus. And whereas
A lot of
there's
supplier power in the
dozens.
Four Forces framework.
Exactly. And so perhaps in a similar way, all these LLMs have to buy their chips from NVIDIA. So maybe NVIDIA is kind of the GE or the Rolls-Royce for the engines. So anyway, you could go deep on this.
Stuck in the middle is the way I look at it. Like if you look at the stack of AI, it kind of goes up and down like a whipsaw, up and down the stack. And so right now we're seeing NVIDIA at the hardware layer get all the return, right? Because there's just so much demand for their airplane bodies, right? Their engines. And then, the airlines are kind of stuck in the middle. And then you have upstream, you have like the booking.coms and the Expedias of the world just printing money, right?
That's right.
That's the AI forward kind of SaaS companies, the vertical SaaS, the AI platform SaaS layer. And then you got these large language models kind of stuck in the middle, competing and getting commoditized. People don't, I think a lot of folks don't fundamentally understand like tech history in that way, or business history. And that's kind of where they're at. They're kind of stuck. And then along comes DeepSeek. Oh yeah, we got you. It's 10x cheaper and just as good. And now it's just a race to the bottom. And you can see OpenAI just, oh no, we got the 4.5, we got the O3. They're just like frantically releasing models. I think you're calling it, and I agree, which is, I think the over-under is probably 2026, where people are just like, oh, AI was overhyped. It's never going to work. It turns out this is really hard. And all, you see like OpenAI raise down rounds, Anthropic sell for a pittance to AWS. And there's a consolidation and a reset that happens. But on the other side is the plateau, right? In the Gartner hype cycle.
That's right.
Yeah, I love that.
I think the way that it may flip is if one of these really does figure out AGI or something like that is head and shoulders above everything else, and they can kind of actually generate a monopoly. If one of these can get to a monopoly in that layer, then they can charge whatever they want. They can expand their margins, and that one will do well.
Yeah, and I think AGI would, even if they developed it, let's say OpenAI's like ChatGPT 5 model comes out and it's a multimodal model with all the models under the hood, and it can just basically do everything for you. Just like you could talk to a competent bachelor degree person and they would just go execute tasks. I think all the other model providers would figure it out right after them. Yeah. So I just don't think there's a sustainable technical moat there. I think what happens is everybody gets super, super efficient at creating startups and creating value. And we just entered this like post-scarcity, super abundant, post-capitalist phase of our existence where we don't even know what economics means anymore because there's just so much like value being created by AI and robotics.
Yeah. What could conceivably happen is something like Google, where in the first wave of the .com era, there were something like 20 different search engines. They were all heavily funded. They didn't seem that different from one another. It was a big race to the bottom. And then Google figured out a better algorithm, and they were able to patent it too. And with that, everyone preferred that. They were able to effectively monopolize search from it previously being a very competitive industry. If someone can kind of have a similar insight, like Google insight at the AI model layer, and everyone starts gravitating to that the same way. Like at one point, everyone just started using Google as the search engine.
Yeah, there could be the Google
there
moment.
Could be something like that.
And that could be the 17th search engine that comes along. The 17th AGI may not even be the first AGI. The first AGI that comes along might be Alta Vista equivalent, or Lycos, or Excite, or one of these like early search engines. And if you're a concentrated investor that only does 20 in your portfolio, guess what? You might miss that 17th AGI that comes along that really, becomes a multi-trillion-dollar company because you're like, oh, I'm already in an AGI company.
So hopefully what'll happen for us investors is that all these other AI models will go bust. Everyone will freak out. The money will leave the industry. There will be a public company like Amazon in 2002 where the stock price is down 95%. But we will see that everybody is using that and their revenue is growing and they're profitable, and we can go buy it, at 5% the price and then ride it for the next 20 years. Or we'll invest in the Google IPO in 2005. Maybe that was hot. I think Google IPO'd at like, is either a 400 million or 600 million market cap.
Well, back then, that was when you IPO'd, it was like $500 million. And now it's like, oh, well, why don't you wait till 5 or 10 billion, the IPO? I think the average IPO is like 8 or 9 billion now. which
I
is
know,
which
it's
is
crazy.
crazy. Yeah.
But maybe that'll still be a good deal. So hopefully we'll be able to identify the Google or the Amazon, and we'll buy
Yeah.
it cheap and write it for the
Well,
next
you
20
let me
years
know
and
if you
make a lot
see
of
it. When you see it,
money. See what I can do.
well, I'll remember this conversation. If you could invest in any historical figure startup, who would it be and why?
But Ben Franklin.
Ooh, I love that. Did he have a
I don't
startup? He had a
think he had
newspaper.
a startup. He was just an inventor.
Yeah. He had a
He comes
newspaper.
to mind.
He's a media
Yeah, he had a
guy.
newspaper. He invented the bifocals. Yeah, he came up in a book that I'm reading with my kids right now.
Yeah, I love that.
Just as this great story.
Speaking of books, what's a recent book or article, or could be a while ago, that shaped your thinking on venture?
That's a good question. I haven't actually. I used to read a lot of books, but a lot of those are out of date. I think I read Jason Calacanis's book a long time ago. I read David Rose's book. I read like Bill Draper's book. I think I read a bunch of others, and they're all great. But the reality is, my best source of information for following venture and thinking and markets is Twitter these days. I'm a big Twitter addict.
Yeah, I need to.
Or
I need
X
to up
now.
X. Yeah, let's call it Twitter. I need to up my Twitter game. But I do find myself gravitating more and more towards Twitter and just kind of going through the feed. I just learn a lot about how people are commenting on things. And how do you maintain, I don't know, like balance in what you do? As a high volume investor myself, I just find this job to be all consuming. How do you have a family like I do? Like, how do you kind of maintain this balance and make sure you're not burning yourself out?
That's a good question. In my case, it sounds like maybe similar to you. I don't do a lot of social events and I do very few meetings. I think the stereotype idea that most people have of a VC is someone who's in their office taking meeting after meeting all day, hearing all these pitches, meeting with their partners. And I don't do any of that. Like I literally do probably 3 to 5 Zoom calls a week with people that I might invest in.
Wow.
I do a ton of filtering over email and the reading the decks and emailing back and forth. My partner, Thibaut, and I do communicate almost entirely asynchronously by text. And we communicate multiple times a day, but we almost never talk live. Part of it is time zones. He's in Dubai, but also it's just like so much more efficient. And I think I find, at least for me, it is very draining to do the in-person meetings, do the social events where people want to talk about VC, or, they want to pitch me on their idea and all that. And I've kind of removed a lot of that from my life. And maybe that's a sacrifice. I sometimes I wonder if it would be good to have more of it, but I feel like I keep my energy up by being, say, as an introverted VC. I do almost all of it in email, reading, writing, async, and box out a lot of that stuff that takes
I
more
need to
energy.
do a better job of that. That's a really good inspiration for me because I do have meetings all freaking day.
Mm-hmm.
At least 10 or 15 meetings a day because I'm always fundraising and always getting pitched, right?
Yeah.
I've been throwing up the guardrails a little bit more on the screening. I'd love to hear your screening process. So you get a deal intro. I assume you probably only you get a lot of cold outreach. Do you even look at the cold outreach anymore? Yeah.
No, I just find it's not like, I'm sure there's some good ones in there, but it takes a lot more effort to filter through.
I'll basically, what I'll do with my cold outreach is I'll send them to Airtable, have them fill out a form. I use ChatGPT to score it based on a prompt I've developed over years of using ChatGPT. And if it hits a certain scoring threshold, I'll look at it. And if it doesn't, I just auto decline it. So it auto declines about 70, 80% of the cold outreach. So that's kind of my screening process. It's still a work in progress. It's not perfect. And then what about on intros? Like I send you something. I'm like, Peter, look at this.
Yeah, so I'll read the materials that are given. So here's something that really flipped for me. So I used to believe that there might be important insights or amazing information in the meeting that I actually take with the founder.
Mm.
And what I found is that they always put their best foot forward in the outreach. So in either the blurb or the deck, if they have good revenue, they scream it from the rooftops. If they have a lot of users, they scream it from the rooftops. If the founders have amazing backgrounds or great team members, that's one of the first slides. It's like, here are the great things about it. Come and talk to me. And what I've just found is that if it's not in the initial blurb that I'm sent or in the front of the deck, there isn't going to be some like, oh my God, this is incredible thing that comes out in the call. It never happens. And so what I've just found is it's like, if I get excited about it based on what is given to me up front, and I feel like, wow, like if this is all true, 80, 90% chance I would invest. And then I take the call, effectively to sell the entrepreneur on taking my money. We'll talk and I'll ask a couple questions where maybe there's some holes. But for the most part, if I take a meeting, there's a greater than 50% chance I'm going to invest.
I feel the same way. It's almost the same. Yeah. By the time I take a meeting, it's maybe not as high as 50, but it's definitely, 30 to 40, somewhere in there.
Yeah. Yeah. There's literally never a case where they don't show their revenue and then they have amazing revenue. It's like, that never happens.
Yeah. It's kind of like, it's just like the too early response that you have. I have it shortcutted. I use TextBlaze. It's a little Chrome extension. And I have about 100 different shortcuts in there of just common phrases I need to say over and over again. Too early, stay in touch. Too late, thank you. You know, like everything is like a 2-letter shortcut.
Yeah, smart. I'm sure founders are often frustrated by this, but the reality is, like, you know, you and I both get a ton of opportunities, and we just don't have the bandwidth to take it all.
And I don't have the bandwidth to explain my decision making every decline either. Yeah. You know, once I decline, it's like, can I get some feedback? Nope, archive. Sorry, I already replied. Yeah. What about your due diligence? So, like, you meet the founder, you like what you see. Tell me about your diligence process.
Yeah. So first, we pretty much only take meetings through warm intros, and and then also it's like, we want to know that the person making the intro knows this founder well, has worked with them, or has invested in them, or something like that, where it's like they can actually vouch for them. So if we take the call, there's already a great reference on there, like someone is already vouching for it. So that helps a lot in terms of verifying that okay, this person is, you know, nobody wants to make someone who is doing work for them, they refer, look bad. So it cuts out a lot of kind of bad behavior or deception.
I've stopped sending out intros unless I'm on the cap table, basically.
We do a lot of kind of cross-checking, like on online footprints. If one of the first steps is I always look at the founder and the team members' LinkedIn profiles. So something that often will come up is like, the founder claims that they have this co-founder and that team member, and I'll go to their LinkedIn and they won't have the company on their profile. So that you asked about red flags, that's a red flag.
Yeah.
If
unless they explicitly say like, hey, this person's coming full time after the round, saying this person is like presenting them as a co-founder, and their LinkedIn says they're still at Amazon or whatever. It's like, are they a co-founder?
Yeah, even if they say once we get funded, we'll join, that's also a red flag because it indicates lack of conviction. It's like,
yeah, I like that.
I want to invest in founders that are going to go build their business one way or another. I don't want to do the ones where they're just kind of going to do it if they get some funding.
Yeah, it's tricky if you're at a corporation though, because you don't want to advertise to everybody that you work with and your boss that you're working on a startup.
True, that is hard.
Yeah,
you're right.
Yeah,
it depends. And then also there's other online kind of public footprint stuff you can cross-check. So if they claim to have traction, you can look at the reviews online, or you can look at the number of downloads on the Google Play Store, stuff like that, to kind of triangulate and say, do they probably have what they claim they have?
Right. Well, they better. It's securities fraud if they don't, right?
Right. Although evidently some people haven't worried about that in the past.
It's very rare I uncover fraud, like 1 out of hundreds. It does happen though, where I'm just like, you're basically lying right here. You lied to me. Yeah.
It is always really freaky when you encounter it. I've kind of spotted it a couple times, and it's just like,
what?
It's very shocking. Yeah. We've been very lucky that we have not invested yet in a case where we later found out that it was fraudulent when we invested, but we have had a couple where the founder committed fraud afterwards, and the company collapsed because of that.
I'm sure it'll happen. I mean, we're high volume investors. That's another benefit, actually. It's like you just see a lot more. You just see a lot more, right? And so you just get a lot more pattern recognition for stuff.
That is big too. Like you can often kind of, after seeing so much, you can kind of sense when something's a little bit off.
Yeah. Well, this has been an amazing conversation. We could have talked for another couple hours. We'll have to have you back on the program at some point. Thanks so much for coming on.
Brian, I really enjoyed it. Thank you for taking the time and having me on. It's been really great talking to you.
Yeah, thanks so much.